We live? Well, hold on. I want to bring you up though. Let me bring you up. We live. Good, good,
Yes,
good,
we
good,
are
good.
live.
Well, let's let the beat build a little bit. Let's let the beat build just a little bit. What's going on, y'all? What's going on? It is a beautiful Thursday evening here in New York. Hopefully, it's beautiful wherever you are. You are in for a treat tonight. You are in for a treat tonight. Mr. Millings is back. I get to teach. Anytime I get to teach, it's a truly an honor. So I thank you for being here. We're gonna let the beat build a little bit. There's a lot to cover. I want to be respectful of time, but they told me, look, go overtime if you have to. You kind of you call your own shots, man, when you own your own thing. And so my brothers have blessed me with the opportunity to do that. And so yeah, we're gonna get things going. How we doing? How we looking? People in here?
Listen, they were not playing around. We already got
They in here.
444 people on.
Oh,
They
let's
did
do
not
it.
play.
Yeah, man. So shout out to all the earners in here. It's been an amazing 3 months, Magda, hasn't it?
It has been.
Yeah, we've been rolling and we're gonna continue to roll. Shout out to everybody that was here for the first class, everybody that was here for the second class with myself and Ian. We're gonna combine the two because I know there's a lot of people. I was getting DMs. I was like, they were like, Troy, we don't know what we're doing and we need help. And I'm like, that's cool. So we're gonna have something for the beginners in here. We're gonna have something for the intermediate people in here. My advanced peoples, just stay tuned. My advanced people, stay tuned. So I'm gonna give you a little preview. I'm gonna do a couple of things that I've never done, like ever, like never ever tonight. I'm gonna let y'all see the portfolio a little bit because I think it's important. And rather than seeing the money that's in there, because there's money in there, I want you to see the percentage growth and kind of how I'm looking at things, and hopefully, you can implement it into your plan and figure out how you're gonna start looking at things. We just here to teach, educate, and uplift. And so that's always going to be the goal. That's been the goal. And we're going to continue to do that. So I'm going to do some new things. I'm going to show you some new sites that I'm using for my research because I'm big on research. And Magda, I already showed you. I gave
Yes.
everybody, I should text it to you. I gave everybody, when I'm talking about do the research, I'm going to show you exactly what I'm doing every single day. And so my days usually start at 6 a.m. for that first hour and a half, at least until like 7. I got to get my daughter out to bed finally because she got to get the bus. I'm reading and I'm skimming through publications just because I need information. The more information I have, the more I can give back. And so my ultimate goal is to continue to be a lifelong learner, right? Because if you're going to be a lifelong learner, then you're going to be able to teach forever. And I want to teach forever. So I'm always going to be a lifelong learner first. All right. So we're going, how we looking? How we looking?
572 people are on and ready.
They ready. All right. So let's do it. Let's get this thing going. All right. So welcome, y'all. The Options Trading Boot Camp. Get your pens ready. Get your pads ready. Questions in the chat. Hopefully, I can get to some of them. We'll see. We got a lot to cover. So I'm gonna try to do this in an expedited fashion, but in a way that makes everybody feel comfortable at the pace that we are going. All right. So this is a great picture. Shout out to this picture. This is from Nigeria. My wife was proud. She's happy when she saw that one. So let's get this thing going, y'all. All right. So here's what we're gonna be talking about tonight. Here's what we're gonna be talking about. So here's our trading overview. We're gonna talk about what options are. We're going to talk about what option contracts are. We're going to talk about what type of investor you. And I think that's very important. I just shout out to G. He's in here. He said, Troy, you asking the most important question. What type of investor are you? And so that's very important to know because in order to be in this space, it is very volatile and it has considerable risk. And we want to make sure that we make gains and we don't take losses. Of course, losses are part of it, but they're also lessons. And so we want to make sure that we understand who we are when we're about to get inside of investment. The last session, we talked about how to evaluate a company. But this time, I want you to evaluate yourself a little bit and figure out who you are. Are you the person that has the computer in front of you from 9:30 to 4? Are you somebody that just kind of checks in every, maybe once or twice a day? Are you somebody that just, puts in a trade and you don't look for 2 weeks or 3 weeks? Those type of things are important to know because they'll let you know your risk tolerance, right? Some people, they see $500 go to 450 and then that's it. I'm out of here. And so we want to encourage people to have the stamina and the financial discipline, but also have the education that makes you feel comfortable enough to be in a position whether it goes down just a bit or it appreciates. Right? We always feel happy about that, but nobody wants to see the downside. It's just part of the game. nothing is green forever. So we're going to figure out what type of investor you are. We're going to go over calls and puts. And we're going to go over terminology. For my beginners, I know it's going to feel like foreign language, but the reason we're going to talk about it is because we want to make it common language. We want to make this commonplace. I told you financial literacy is cool, but financial fluency is more important. That means that you are able to speak, understand, comprehend, and decode the language. And so my goal is to make sure that you're financially fluent, especially when it comes to trading options. We're going to read the option chain. I'm actually going to take you inside of an option chain so you can see what that looks like. If you've never done it before, it can be a little bit overwhelming and a bit intimidating, but I'm going to walk you through it and hopefully you'll feel comfortable. We're going to talk about bids and asks. We're going to talk about how to find undervalued contracts. Now, if you were watching Market Mondays, shout out to you. We went over how I was evaluating undervalued contracts. We're going to talk about HubSpot. Don't think I'm not going to talk about HubSpot, and I'm going to show you how we make money in HubSpot. If you made money, shout out to you because it definitely it definitely had a great opening, and it had a pretty average close. It closed yesterday at 597, and it closed today at 597 again. And so there wasn't much movement, but if you watched it open today, then you understand completely what I'm talking about, and I'm going to show you what that means. And I didn't put in this, but like I said, there's going to be a couple things that I'm going to be talking about tonight that I've never done before or shown before. And so you're in for a treat. And since this is EYLU and y'all family, I'm going to let the family in. We're going to let them inside the house and see what the portfolio is looking like. Some wins, some losses, some lessons learned, and some strategy that we found inside of those lessons. So let's get this thing going. Notepads ready. Magda, what's the number? Give me the number. Tell me the number. Where we at?
We're at 7:15.
Oh, let's rock. Let's do this. Let's do this. All right. All right. So options trading, as simple as I can put it, is essentially predicting the future price of a given asset. An asset could be in equity. And I say equity because some people are like, well, it's not just stocks, ETFs too. Yes, it's both. What you're doing is pretty much saying where that is going to go. Is it going to go up or is it going to go down? Now, if you're predicting up, that's a call. And if you're predicting it's going to go down, it's a put. So here's our examples. And Meta is going to be our stock today just because I am a disclaimer. I'm a shareholder inside of Meta. And so we're going to be using that. So Meta today is trading at $575, give or take maybe 20 cents. All right. So if you predict that future price is going to be, right, if I ask you, do you think Meta could get to 495 in a specific time? And you say yes, then you pretty much have made an options call, right? You've said that the asset is going to move in price, is going to go up. Fine. Now, if I give you a specific date, like there's one here, December 18th of 2026, that becomes our expiration date, and we're going to go over exactly what that means. So predicting a price point for a specific time for an asset, that is pretty much what an option is, whether it goes up or whether it goes down. All right. So what are contracts? This is important. This is important. All right. So an option contracts offers you the opportunity to buy or sell an asset depending on the type of contract that you hold. The chosen asset at the price set out in the contract and that expiration date. And so what that means is you have the opportunity to buy. So you're not obligated to, but you can buy an asset at a given price. And so that price in the example was $495, right? If the asset goes up at $495, you can buy it there. If it goes to $595, you still hold the right to buy it at $495. If it goes to $695, $795, $895, if you have a contract at $495, you have the ability to buy 100 shares at that level. And I'll show you what that means, and we're going to walk you through. All right. So most people, and I didn't talk to people about this last time, but maybe I should have. They'll say, all right, this is all great. I know what a contract is. I know if I predict it going up, it's a call. I know if I predict it going down, it's a put. But where do I find these things? And so this is important. You can find them at any brokerage. So if you have a brokerage account, usually when you're filling out the form to actually join a brokerage, they're going to ask you what type of trader you are. And Magda, maybe I'll schedule during the week a process of opening an account and actually going through an actual trade live so they can see what it looks like. I think I want to do that so people can understand. And so I've given you 3, and I've chosen these 3 because I actually have all 3 of these accounts. So I have an E-Trade account, I have a Fidelity account, and I have a Schwab account. And most people are like, well, why do you have 3 different accounts? Well, here's why. Each brokerage account is made for a different purpose. And so my E-Trade account holds a lot of my option calls and puts, and it has some shares, some equity shares inside there. My Fidelity account is strictly for my indexes. And so inside there is my VOOs and my VTIs, and a few other SPYs in there as well. Not SPY, QQQs inside there as an ETF. And so the Fidelity account is specifically for that. And then my Schwab account is strictly shares. And so inside there, I have probably 600 Apple shares. My AMD shares are there. Some of my Disney shares and my Amazon shares are there. And so I don't do anything in there but just buy shares. And so that makes it very easy for me. I don't have to go looking around saying which account is which. I have it laid out very clearly. My E-Trade account is for the options. Fidelity's for the indexes, and Schwab is strictly for solo entities or solo equities. Now, which one is my favorite? I started with my favorite, which is E-Trade, just because I think the simplicity of the platform makes it very easy for you to find information, and also makes it very simplified when you're trying to open and trade. And I'm going to show you. So every example that you'll see, every screenshot that you'll see will be coming from an E-Trade platform, and you'll see in a sec what that looks like. All right, so this is the question. This is the question you got to figure out. And I can't answer it, but only you can. And Magda, maybe they can put this in the chat. Put this in the chat. Like, what type of investor are you? So there's 3 types we're going to talk about, and the 4th one I'm going to give to you. So there's scalpers, there's day traders, and there's swing traders. And so if you can't read it, I'll read it to you. It says scalping entails the buying and selling of a financial instrument, usually a stock, future, a currency, commodity, or even an option, with the goal of producing a small gain, or could be a large gain, on that position. Scalpers attempt to profit from short-term price movements. So really quick. Now, this is the most important part for scalping. The time frame that scalpers trade hold positions ranges from seconds to minutes. And so when I told you to figure out what kind of trader you are, a scalper is somebody who's in front of their computer and they're doing this by the second. I mean, every second counts when you're scalping because movement happens, volatility happens. And so people who do this are, I mean, I always like to say this is strictly for live men, not for freshmen. And since we got a lot of freshmen in here, I wouldn't advise this yet. If you haven't traded before, I wouldn't advise you to start scalping right away. Yes, you can make money in it. Is it volatile? Is it risky? Yes. And so we want to take that into account. Now, there are day traders. And that sounds pretty self-explanatory, right? So the strategy for day trading involves taking positions into financial assets such as stocks, futures, currencies, same pretty much thing, but the day traders tend to hold the abundance of trades over minutes and hours. And so my scalpers, we're talking about seconds and minutes. My day traders, we're talking about minutes and hours as a maneuver their transitions throughout the changing market conditions. And so I know Ian talks about this a lot when we're talking about day trading, especially in the futures market, where it's, hey, we trade the open and we trade the close, right? So it's between 9:30 to 10:30, and it's between 3 o'clock to 4 o'clock. Why? Momentum shifts in the morning, momentum starts to shift again in the evening, and then during the day, you don't see as much movement. And if you've watched any chart, even if you watch CNBC, you know, as soon as it hits 9:30, you'll start seeing colors flashing. It'll be red, it'll be green, it'll be red, it'll be green. You're trying to figure out what's going on. Trades are happening. And so there's a lot of flow that's moving in it during those times. And so day traders, they capitalize on that time movement. Now, and it seems like we got a lot of these people in the chat. So shout out to everybody that's in the chat. We got swing traders. So unlike scalpers, and no knock to them, and unlike day traders, shout out to y'all. All right. Swing traders hold their positions for longer time periods. This can be for several days, weeks, even months, and is dependent on the asset, the trend, and other existing positions of that swing trade. And so swing traders are a little bit more disciplined, more patient, and are looking to have returns not immediately, but over a course of period of time that is a lot longer. So we're talking about several days, weeks, and months. Now, I didn't put this one in here, but the 4th one would be an investor. Right? You are an investor. That's your type of investment, right? You are an investor. And that means that's your long term, right? So you're looking at holding positions from anywhere from 2 to 5 to 10 to 20, 30 years. So we want to make sure if we're going to be involved in trading, we figure out what is our palette for trading. I will personally tell you, I don't have the stomach for scalping. I don't have the time for it. I got too many calls. I got too many meetings. I wouldn't succeed at scalping, right? Day trading, again, I'm traveling a lot, moving around a lot. When I was at work, it was tough. I got kids. I'm trying to teach them how to skip and hop and hula hoop. And it was too much, right? I can't concentrate on it. Swing trading, I was like, okay, I can give that a try. You know what? I need more time than a week, right? Especially how I like to do it. I like to do my research, take my time, make the investment, and watch it flourish. And I'm pretty good at watching my investments flourish. And we'll come back to that. I feel like K Dot when I said I'm coming back to that. We're going to come back to that, though. I'm going to show you how they flourish. All right. So figure out who you are before you trade. All right. This is important. This is important. And usually when the teacher puts things in bold and the letters are bigger than everything else, this is vitally important. And that's what this is. Option contracts are not shares. So you don't own any shares. You own a contract and they are a separate entity. Now, each contract represents 100 shares. Now, you could, and we'll talk about exercising contracts and not exercising. You could own 100 shares. There's a premium for that. Or you could just take the profit that is made from the appreciation of buying an options contract. Don't worry, I'm going to break this down to you so you can see exactly what this means. But you need to know that the contracts are not shares. All right, so what does the contract look like? So it's a stock option contract is the option to buy or sell 100 shares of an asset at a chosen price by the set date. That would be that expiration date. We're going to go into that in a little bit. Therefore, each contract should be viewed as a potential 100 shares. So if you had one contract, right, that means you have the potential to buy 100 shares at that selected price. I know we use the example of $4.95 for Meta. So if I bought one contract, I have the option to have 100 shares. If I had two contracts, now I have the option to buy 200. If I did 3 contracts, 4 contracts, you can follow along, right? Each one of them equals 100. And so most people, when they look at it, they'll say, oh, I bought all these contracts. But most people don't intend to buy those amount of shares, right? I've seen people buy 100 contracts, option contracts on a company. They're not looking to buy 1,000 shares of that company, right? They're looking to see how much money can they make from the appreciation of that option called growing over a period of time. And so we need to know that. Magda, how we doing? We good? We live. All right, perfect. Magda, if y'all can't see her, but she's on my screen giving me the thumbs up. Shout out to her. All right. So there's 2 types of contracts, and we're going to make this as simple as possible. I know last time I was like, maybe it was, I looked at it, I was like, maybe it's a little wordy. Maybe people don't get it. I'm going to make it as simple as possible. 2 types, there's calls, there's puts. And so a call option prices go up and down with the stock price. And so if Meta goes up, its call option will go up, right? If Amazon goes up and the stock price goes up, the call price goes up. If Apple's stock price goes up, its call options go up. And so calls are bought with the belief that the stock will go up in the future, right? So we're looking at a company, let's say Meta, and it's trading at $475.42 per share. That's what it presently closed at today. If I believe that is going to get up to $600, like in this example, that is a call. I'm getting one contract of Meta for a future date, and I put it out as furthest as I can, December 18th, 2026, for $600, right? So the price has changed. It has gone up over time from $475 to $600. I've given it almost 2 years to do that. And so I'm predicting and I'm having belief that the option or the stock itself is going to appreciate. And so this would be an example of a call. And even better, I'm going to show you a picture of what this call actually looks like. This is not a make-believe call. This is actually a real thing. And so we have Meta here, and it tells you at the top, it says Meta December 18th, 26. This is the 600 call. A couple things I want you to look at on the left side of your the screen, right under snapshot. And so it says open. And this is where the option open. This is not where the stock price open. This is where the option open, right? So a lot of people when they think about options, they get so confused. They're like, that's a totally different number than what Meta's trading for. And you're absolutely correct. It is, because one is the actual stock and this is the actual contract at this price. And so it opened at this number. You can see where it previously closed at. Volume, which we didn't talk about in the first session, but it's vitally important. I brought it up on Market Mondays this Monday. We're going to go into that. Open interest, vitally important as well. These are some of the things you need to look at when you're starting to trying to figure out which option contract best fits you and which one you're going to get onto. Now, also highlighted here, there's an underlying price of volatility, but there's also an option price and volume. And so I told y'all I like to find depreciating contracts. This is definitely one. I just picked this by like happenstance, but you can see it opened nearly at 120 and it dropped down all the way to 70. It's in my range, right? I told you I like to see a 40% depreciation, 50%, even better. I'll take anything over that. And this nearly touched that 50%. So I definitely, I might have slipped this in here for a reason, but we'll see. All right, so this is actually what the call looks like. I just want to get everybody. And that number, right? So if you're looking at 88, I want you to pay close attention to that, right? Most people will look and say, oh, this call is $88, right? But there's something called an options multiplier. And I'm going to go over that in a sec. That really just means times 100. And so I remember being in like 5th grade and, we're doing decimals and you had place value. So I always tell people when I'm trying to teach them options, I'm like, let's go back to that time when you had to learn place values. When you're doing an options call, every time you see a dollar amount like it is here, I want you to move the decimal place 2 spots over, right? So you're going to move over the 10s and the 1s, right? And so that $88 really represents $8,800. I'll show you why. Don't get confused. I'm going to show you why. I'm going to show you. All right. So we got one side of it, the appreciation, which is great. They're asking if I can use the cursor. Yeah, can you see the cursor moving, Magda? Or no? You can't see it. Yeah, it's not. I tried to do it before. So in the slideshow, in the actual slideshow, I circled things, but in this presentation, it didn't circle. So what I'll do is after we're finished, I'll put the entire slideshow in with all the circles so that everybody can see it. That's cool. Thumbs up if that's good. We good? Yeah, I'm looking at it now. I'm like, I definitely circled that. I don't know what's going on. All right, so we got the first side of it. We got the calls, and that's if the stock is going up or the option is going up. But a lot of people don't utilize this, and they should. It's a way of hedging. And hedging just means I'm putting money on both sides. I'm putting money to say that it'll go up, but I'm also putting money that in the event that it goes down. And these are called puts. And so put option price goes up when the stock falls. So this is the actual inverse of what we just talked about. So when you have a call, if the stock price goes up, the call goes up, right? The put goes up when the stock price falls, right? And so when the down, it goes down when the stock price rises, right? So we're looking at a company to say, all right, there's some factors, there's some issues, there's some economic news that's coming out. This company might actually fall down in the stock price. So puts are bought when the belief that the stock will fall in the near future. I'll give you a prime example of it. We saw it with, we thought we were going to see it. That would be a great example. We thought we were going to see it with Tesla. We talked about all the negative news. We talked about all the delivery issues. We talked about some of the factories getting shut down. We talked about China being on its heels. We talked about BYD coming into space and taking some of their clientele. We talked about some of the issues with the Cybertruck, all those economic issues and fundamental issues, even some of its technical issues. It was down 42% coming into its earnings. All those signs would say, all right, we're going to make a put on this. We're going to believe it. They're going to have underperform on their earnings report and the stock's going to depreciate. What we saw was the inverse, right? And so they call these people short sellers, people who have taken all those things into account and say, because we have all this information, it's going to sell lower than it did the day before. Well, the opposite happened, right? The actual opposite happened, and Tesla did go up after its earnings. And so if I'm looking at information and saying that the stock price or the equity is going to go down, I'm going to make a put. And so the example here, Meta trades at 475, just like it did when we were trying to make the call. A put was saying, okay, I'm going to buy one contract of Meta for June 21st, 2024 at $450. So the $450 represents a lower price than where it currently sits at, right? Now, this something I need you to notice. I'm going to go back really quickly. When I did the call, look how far out I went. I went to December 18th, 2026. That gives it time to fluctuate. Economic issues, interest rates will change hopefully by 2026. I'm taking all those things into account before I make this call. Look at the time frame on the put though. Right? So the time frames on the put are a lot shorter, right? Because we don't need all that information, right? All we need is a little bit of information in a short period of time to say that this company is going to trend down. And it could be anything, right? The Fed chair could say, you know what, we're not raising interest rates until June of 2025. That type of information, especially for tech companies, will hurt the stock, and you'll start seeing a decline, right? Or, hey, you know what? Meta is being sued by, Congress, right? That could change the trajectory or the signal for the appreciation of Meta, right? It might start trailing down. And so this would be a put would be in place for that. And so this is exactly what the put looks like. And so notice, let me go back so we can highlight this really quickly. Notice after near the 88 up here, you see that it went up 8 cents, right? That's because Meta's stock went up today, right? Now look at the inverse. Because Meta's stock went up today, this put lost 15%, right? Because Meta went up at the stock price, this put, right, it's moving further away from the 450. It actually went down 15%. And so people who had puts on Meta, they're losing money at this point. The people who had calls on Meta because of a day like today, which it went up nearly 1%. Still, anytime you see green, you're happy. Anytime you see red, put your seatbelt on. It's not a great feeling. It's not a great feeling. Magda, how we doing? We good in the chat? We still good in the chat. Shout out to the chat. All right, so I talked about, it didn't circle it. But at the bottom, this is circled on the slideshow. It says options multiplier. Maybe if I do this, Magda, can they see it better if I do this? Right at the bottom left down here, it says options multiplier. It's right before the word deliverable. Options multiplier means times 100. And so this is what that slide is going to tell you, right? So a contract multiplier just means that the equity call and put options have a multiplier of 100. So each option contract controls 100 shares of the stock or the ETF. Here's the example, right? An Apple call put option with a $2.50 premium has an actual value of $250. So we went from, remember I told you about moving that decimal place to the tens and the ones? This is exactly what this just happened. So if the premium's $250, that actual value is $250. That's what that contract is. And so I put that in my notes. Move the decimal in the premium 2 places to the right. That means your tens and your ones. So in that example, we went from 250. Hypothetically, this is what actually happened. 250 multiplied by 100. $2.50 times 100 equals 250. For the example that I'm going to use here, it says the put was 740. So if we multiplied 740 times 100, we get a $740 per contract. So that's what it said, right? Yep, 740. And so if we move that from the tens, we move that to the ones, $740 for each one of these put contracts. All right. Now, these put contracts aren't as expensive usually as call contracts, because one thing that we know about the U.S. economy and the stock market is that it has a tendency to appreciate over time. In fact, since 1943, 70% of the time, the market has risen. And so the premium for having calls is going to be a little bit higher than it is for puts. Let's keep rolling. All right, so the options, this is important. We're not just making these things up. And so in order to have an option, number one, you have to figure out what price you're going to predict the stock is going to move to, or the contract is going to move to. And that number is going to be called your strike price. So the strike price is the price at which an asset can be bought or sold. It is the price that the given asset will appreciate, a call, or depreciate, put. And so let's keep it with the Meta theme. So if Meta is trading at 475, I'm making a call. That call number, right, is my strike price. That means it's going to go up. So 490, that could be my strike price. That should say 450. I'll change it. If I make a put at 450, that means it's depreciated. That means the put has gone down. The value of the stock has gone down. So that would be my strike price. And what does that look like? So in the middle of your screen right here, right under the word June 21st, 2024, you're going to see a list of numbers. There are a list of numbers here. They go from 450 to, and it says my slide, 495, right? Those are all the strike prices, right? So, and I'm going to walk you through this. This is just a screenshot, but I'm going to take you through the actual visual of what this looks like so you can see it in real time. Because when you look at all these numbers, it's like, oh my gosh, this is overwhelming. I can't do this. Trust me, you can. And when we walk through it a little later, you're going to see exactly how to maneuver around this and make this really simplified. And so the strike prices are dead in the middle of the screen. That's the price that I'm saying either is going to go up to or either it's going to fall to. Let's move. All right. And so that's for the strikes. Then the expiration date is important as well. And we talked about having long term. We talked about having short term. Now, if somebody is a day trader, they're going to be looking at weeks, maybe months when they make their options call. If we're talking about a swing trader, right, we're talking about somebody that might be looking at months, maybe years, and somebody that might do leaps, right? We might put swing traders in when we're talking about leaps as well. Leaps means that the options are going to go past a year, past 2 years, sometimes maybe to 2.5 years. So the example I'm using of Meta when it was at December 2026, that's almost 2.5 years from where we presently are. That would be a leap. We don't like to use the word long term because long term really is associated with anything past 5, 10 to 15 years. All right. And so your expiration date is the final date on which a contract is valid. Now that usually happens on every Friday. And so when we start to see volatility on Fridays, we know that's because a lot of contracts are being sold in the options market, but contracts are being sold in the futures market as well. So Friday is always a pivotal day in terms of trading. So after that time, the contract is expired. So it's two things you can do. You can sell it, right, and take the profit from it, or you can exercise it, meaning you are choosing to buy 100 shares at that price. I know there was a clip going on Instagram from our first class when I talked about our NVIDIA 205, and people were like, no way, when did he buy that? Well, I bought that in June of 22, and I've held on to it till present day. So I still have a few contracts left, and that's just running. And so I have the ability to buy NVIDIA, which is now trading at $877. I can buy NVIDIA at $205. I can buy 100 shares. At the time I bought it, I bought 5 contracts. So technically, I could have bought 500 shares, but I said, you know, sometimes in life, you got to take the profit. So I chose to take profit. I took profit on some contracts. I didn't sell them all. You'll see it in the portfolio later. Don't worry. It's still there. I'm a patient man. I'm a diligent man. I'm a wise investor. All right. So expiration dates can range in length of time from days. Like we said, shout out to all my scalpers, minutes, right? If they might be in and out of these contracts quick, weeks, months to years. A longer expiration is also useful because the option can retain time value. This is so important. Time, so they call it days to expiration, right? So you might just see the abbreviation DTE. Write that down in your notes if you're writing. If you hear my voice, write that down. DTE, dates to expiration. That tells you how long you have until the contract is expired. I personally like to have as many days as possible. Why? Well, we saw what happened, right? If I made that NVIDIA investment in 2022, the NASDAQ crashed in 2022. It went down 32%. If I was short term on that investment, I would have lost everything. Just calling it what it is. I would have lost my initial investment, which I'm okay with, right? I never invest what I'm not prepared to lose, but I'm also prepared to gain. And so the fact that I extended it so far out to 2024, it gave it time for the NASDAQ to not only depreciate 32%, but then come back in 2023 and have an amazing year. And then in 2024, and we've already seen what NVIDIA has done, it continues to run. And so that's why I like to have my DTE as long as possible, because I want to have the ebbs and the flows and the volatility and the corrections, all those things are going to happen while I still have my contract, which gives me time to, again, completely have appreciation on the value, which I always want to do. No disrespect to any scalpers or day traders or swing traders, just my personal preference. We always talk about, and Shadi talks to me about all the time, risk management, right? We want to make sure that we're taking the least risk as possible, and we want to put ourselves in the best probability to make sure that we make money. And so I always suggest put a longer expiration date. It will cost more, the premiums more, because the likelihood of it happening, especially inside of the mega cap companies, the Magnificent Seven, they're a little bit higher. But I'm going to show you how you can move around that. All right. So these are examples of expiration dates: May 17th, 2024, which is next Friday, which I show you what HubSpot was, and then January 16th, 2026, which is 2 years out. These are examples of short-term and long-term expiration dates. All right. So in this slide, so this is actually circled. So in the middle of the screen, you'll probably see September 19th, 2025. December 19th, 2025, January 16th, 2026, June 18th, 2026, and December 18th, 2026. Those are all examples of expiration dates. And every time you click on it, it will change, obviously, the bid, the ask. And you'll start to see fluctuations in some of these numbers. Obviously, as you go further out, the premiums become more expensive because, like I said, the likelihood of it happening is greater, right? So what does that mean, Troy? Well, if Meta is trading at 475 today, by December of 2026, will it be trading at 480? The likelihood of that happening is very high. And so the contract for that call will probably be very high as well. That's what this means. And I'm going to show you live what this looks like. All right, this is very important. This is very important. This is very important. Focusing on this, right? So there's something called a bid and the ask, and we're going to show you an example of what this looks like in the next slide. But I want you to know, and if you've ever bought a car, you've been through this. If you've ever tried to buy jewelry, especially if you're in the Diamond District, you've been through this. The bid price represents the maximum price that the buyer is willing to pay for a stock or other security. So this is the price, right? I go into a store, I say, I want this ring. I'm only willing to pay $1,000 for it. The ask price is the minimum price that the seller is willing to take for the security. So I go into that same store. Seller says, nope, I want $1,500 for it. I'm telling him I'm only paying $1,000. Either he's going to take this $1,000 or he's going to have zero, right? And if he doesn't have, that's fine. Another seller will come in. Somebody will say, you know what? It's $1,500. I'll give you $1,300. He might say, you know what? If you give me $1,350, I'll take it. This is the same thing that happens in options trading. The bid and the ask price are very important because most people, they neglect this piece of information. And as soon as they make a trade, they're in the red and they have no idea what happened. And I'll tell you what happened. You got bamboozled, right? You paid over the sticker price. You never want to pay over the sticker price, right? Unless it's a situation when you see that equity is moving. I'll give you a prime example. A few days ago, Amazon was moving pretty fast, right? Now, if Amazon was moving and the original price was $1,000 and they're telling you they want $1,300, if I don't make the move, that $1,300 might turn into $1,500. That $1,500 might turn into $1,600. It might turn into $1,700. It might turn into $2,000, right? If I sit at that $1,000, I'm going to miss the ride all the way up. So I got to make a decision. Either I'm going to come up on my price or I'm going to have to say I'm going to wait for it to pull back. This is what it takes discipline inside of investing. Most people will say, all right, fine, I'll go up to the $1,500 and take it. Some will say, I'll wait at the $1,200. I'll go up $200. I'll wait at $1,200. I'll wait for that equity to come back down. Now, most people, I'll be honest, most people are not doing that. Some of us are, and you will see the benefits if you are disciplined in that manner. All right. So let's take a look at the next slide. This is exactly what it looks like. So this is exactly what a bid and the ask look like. So this is that same December 2026 call for Meta. So if we're looking at the 480 number, to the left are the calls, to the right are the puts. Always remember that. On your left side, you got your calls. Right side, you got your puts. So the ones that are in color are called in the money. In the money. So those are profitable. The ones that are not in the color yet, it hasn't reached that price target yet. It hasn't gotten there. And so if we're looking at the 480 call, there's a number there associated. The bid is at 132. That's what they want you. That's what you want to pay, right? So you're saying I'm only paying 100. Well, this would actually be 13,000, right? If we move that decimal, I'd be paying 13,000. They're saying they want 13,500. If nobody budges, the call never gets filled. It's important to know it never gets filled. If somebody budges, if you decide that I'm going to go up to 13.3, right? And the seller, because option contracts are bought and sold, somebody is selling you that. If they decide to accept it at 13.3, then the option contract is sold, and now you have the 480 call. If not, it'll expire, and you can try again the next day. I'll show you what that looks like. What I like to do, right? And most people will say, well, the market price is what I'll fill it at. Well, the market price is going to be the highest value. Now, personally, I never want to pay the highest value. I don't want to overpay. And so when people pay market price, it'll be that 135.10. That's going to be the price it fills at. If not, it'll go higher, right? So as it's going up, it might go to 13.6, 13.7. If you put market price, wherever that highest mark is at the market value, that's what you're paying. Now, if you put a limit price, that's when it becomes variable, right? And rather than saying, I'm going to do the 13.2, I might do 13.250. I might do 13.3, right? So I'm changing my limit. I might go 13.4. I never want to go over 13.5 because that's already the highest bid. I might just say I'll sell at 13.4 and see if it's willing to be sold at that price, and I can get it. And so I always like to use the limit. Now, the next piece is vitally important, and this is exactly what I did a few times, and I lost money, and that is a trailing stop. So a trailing stop is a modification on a stop order. That just means that rather than saying I'm going to take profit all the way up or I'm going to take losses all the way down, I'm putting a percentage, whether it's 10%, 20%. If I hit that number on the way up, it's getting sold, right? If I hit that number on the way down, it's getting sold. Why is that beneficial? Options are very volatile, extremely volatile. And so if you hit that 20% threshold on the way down, would you rather stop there or would you rather go to 50? Or would you rather go to 60? I have myself fallen into positions where I've been down 90%. And it was like, damn, why didn't I put that stop loss on? So I'm telling you in advance, if you're going to, and you're new to this, I would definitely look at using trailing stops or a stop loss to help you in this game because it can be very, very volatile. But we want to make sure that you're having winning percentages because everybody wants to make money. Nobody wants to lose money. In fact, our goal is to make as much as possible. Let's keep moving. And so this is a diagram of what that looks like. And so when you have a call strategy, it asks you buy to open, sell to open, buy to close, sell to close. Why is that important? When you're buying a contract, you want to buy it to the open. This is a new contract. It's a new opening. You're going to buy it at that limit price on the market value. Why is it important to sell to open? Well, this is a prime example of why. On Monday, I talked about HubSpot. At the time, it was trading at $615 a share. I bought 4 contracts. I showed you guys that. On Wednesday, HubSpot fell to 592, 590, I think it closed at, which is exactly where I nearly bought it. I got it at 587. I said, okay, cool. It fell back. That's cool. I already took profit, but I did have it in another account. I said, all right, well, let's just see what happens on this other side. The next day, which is today, this morning, I hit Greg up. I said, yo, you see what HubSpot did? It had its earnings. It fell pre-market to 560 if you were following it on Wednesday night. This morning, it popped up to 640. I said, perfect. I have a sell to open, which means as soon as the market opens, no matter where it opens at, my remaining contracts are going to sell. And so what happened? Check this out. This is at 9:35. I took this picture. I sent it to myself. I said, yo, that's crazy. So from 590, right? It opened at 629. By the time my order was filled, I was able to sell at 620. Now, why is that important? If you look at HubSpot today, if you type it in your stock right now in your app, you'll see that it closed at 590. That ain't no concern of mine. I already closed at 620. And so that's why selling to open sometimes can be very beneficial because I already was like, all right, I'm gonna take my profits again. This time it actually appreciated more than when I bought it, because I told you on Monday it was trading at 6.15. This time it went up to 6.21. So I made money all the way up, and I got out of there like a thief in the night. Shout out to me. All right, let's keep going. All right. And so this is an example again of what that looks like. Market orders, limit, stop quote. I'm gonna start moving faster if that's okay. Can I move a little bit faster, Magda? How are we looking on time? I know people got dinner, but I got at least another hour. We good? Thumbs up if I'm good. We good? They good? They good. All right, as long as they good. Wait, I'm not even on the screen. Let me get back up over here. There I go. All right. No, I can't use that one. Let me use, nope, not that one. That one. Perfect. All right. So what does that look like? So a reminder, a stock option contract is buying 100 shares. That's why you must multiply the contracts by 100. Please, always in your mind, just move the decimal over. If nothing else, remember what I said, your tens and your ones. Move the decimal from the tens place to the ones place, right? Or the ones place to the tens place, because we're using decimals. I know there's a fourth grade teacher right now that's like, that's a decimal, Troy. All right. It goes reverse order when you're talking about decimals. So yes, they said skip dinner. Okay, I will skip dinner. I love these messages. Perfect. We're just gonna skip dinner. Let's just run it. I'm going to keep running. I don't care. All right. So we're moving that decimal. So one contract really equals 700. If you have 5 contracts, remember, so now it's 7 times 5 or 700 times 5. You're talking about $3,500, right? And so that means you have the not the obligation, but the right to do it. All right. So let's move, because I want to go live in a sec. This is important. Options change, and I'm going to go over this. So we talked about the expiration dates. We talked about calls and puts. We talked about bids and asks. Last change, volume interest. We're going to talk about that right now. So I want you to see what that looks like. So on Monday, I kind of brought it up. I talked about the volume and why is that number important? Let me go back so you can. Nah, actually, I'll do it live. The volume is important because in the stock market, the volume represents how often shares change hands between buyers and sellers. And so you always want to look at the volume. A stock or an ETF that doesn't have much volume is not very attractive to me. That means if I buy it, there may be a chance I won't be able to sell it. I don't want to be caught in that position. I always want to be in companies or ETFs or equities that have high volume. What's high volume? I like to have anywhere between 1 million, well, sometimes 800,000 to 1 million trades in a day. So that means the volume is moving that much, right? High volume plays, like even NVIDIA, you're talking about maybe 13, 20 million trades a day. So high volumes means I can get in the position, I can get out the position quick. There's buyers, there's sellers, it moves very quick. Some of these trades, some of these companies that we're looking at where we're trying to hit a home run, their volume isn't as high. And so it becomes a very difficult proposition when you're trying to sell it if nobody wants to buy it. And vice versa. It becomes a very hard proposition to buy it when nobody wants to sell it. So keep that in mind. All right. For option markets, the value metric tabulates the number of option contracts bought or sold on a given trading day. So every day that changes. Every day that changes. I'm gonna give you a site that you can actually see it on. It also identifies the activity level for a particular contract. So that tells you how many people have been moving in and out of that contract. Other thing that we need to look at is the open interest. I'm gonna show you exactly what this looks like. Open interest means the number of options of future contracts held. So people actually have these in their active positions. These positions have been open, but they haven't been closed out yet, right? They haven't expired. They haven't exercised. So they're just in their possessions. Like I have contracts that are just in my possession. They haven't expired. I'm still holding them. I haven't closed, right? I haven't sold it to make profit. I haven't sold it to exercise and buy more shares. And it hasn't expired yet. So those are open interests. Open interests decrease when the contract buyers or sellers close out those positions. So that 205 I'm talking about, whenever I decide to do something like that with it, it's going to decrease the open interest for it. So why? Why are we doing options? Here's why. Okay. The growth potential is very simple. There is maximum growth potential. So growth of an option contract is different than the growth of an asset. The trends are volatile, are vitally important, and they can be volatile, right? And so when we're talking about the growth of a stock versus the growth of an option contract, yes, as the stock moves, the option call moves, but the percentages are very, very different. And so here's an example. If Meta stock, which trades at $475, grows to $500, that's a 5% increase on your investment. That's easy math, right? We'll take that. That's $15. We'll take it. Okay. Tuck it in. We could probably get some Chipotle with it. Right. Now, if that same, right, Meta's trading at 475, if I had an option call and that premium was $7, right? And since it went up to 500, that premium went from $7 to $10.50. Well, that's a 50% increase, right? So that's a big difference, right? We're talking about 5% on the stock, but 50% on the option. And so what does that mean in terms of dollars? That means that the stock went up $15, right? But the option call went up $351. And you can see that the growth potential is much greater, right? It's more volatile, right? So if the stock goes down to 480, it's a 3 to 4% decrease, right? But on the downside for the option, that could be a 20% decrease. And so there's volatility, but there's potential for maximum growth. And so when we're talking about solid companies to invest in, this is why we're talking about it. You want to have a company that's strong, that can withstand pullbacks, can withstand volatility, which is why we also talk about having longer expiration dates, because that's the type of growth we want you to see. We want you to see 50%, 100%, 200%, 300. If y'all start getting into 500%, then I'm gonna start asking for reparations on that. But I want you to win. I want you to win at all costs. And so this is why you see a lot of people flustering around how to learn options, how do we do it correctly, and that's why the growth potential is so much higher than just having a single equity. All right, now I can go live. I can go live now. All right, so we got the 50-minute mark. That's perfect, because here's what's coming up now. All right, so we're gonna do some research. I'm gonna show you some of the directions that the charts are signaling, what economic factors come into play. We talked about this the other night. Find the undervalued contracts, 40% appreciation. That's my rule. And then the last piece, I'm gonna let y'all see what's in the portfolio. Now y'all gotta do me a favor. Y'all can't tell that, right? Because I don't need nobody looking for me saying, yo, bro, I saw your portfolio. Can I host? I don't have it, right? In fact, I don't have it. So this is family ties right now. We're talking amongst family. So just when you see some of these things, this is for motivational purposes only. Motivational purposes only. All right, Magda, I'm going to try to go to this other thing and let me see if I can share my screen. Let me know if I'm good. If I'm good. You can see that? You can see, so you're looking at E-Trade now?
Yes.
Perfect. And Apple's up there. But I'm going to go back just a second. Let me go full screen here. And I'm going to go back a second here. All right. So this is like this is a real E-Trade account. And I'm going to go back because most people are like, how did you even get to that page? So let's go back to the regular. This is my search bar. I'm just typing in Apple in. And when I type in Apple, let's see. Oh, I think I got logged out. Hold on. I definitely got logged out. Give me 1 second. One sec, Magda. 1 sec. I got to log back in. Okay. All right, we back. All right. Where's my StreamYard? There's my StreamYard. And present. Share my screen. Let's do this. And share this window. And thumbs up when you see me. You see me? I'm back good? Thumbs up? Perfect. Let's get to it. All right, so I typed in Apple. This is what it looks like, y'all. This is exactly the research that we're going to be getting into. All right. So I got a couple of pages up here. I'm going to show you one that I actually have never shown anybody. In fact, I didn't even know if I told Ian about this yet, but I will. I'm going to let y'all in on this new page that I've been using over the past couple of months. Greg, if you ain't here, I didn't show you this yet either. So you can write your notes on this too, bro. All right. So here's Apple. Obviously, we can see the equity here. We can see it. Matt, just give me a thumbs up through text if you can see my cursor moving. So we can see that it's trading at $184, right? It made it went up a dollar. Oh, yes, you can see it. All right, perfect. So it moved up $1.83 today, which is equivalent of 1% change. That's great. Here's the analyst research. So you can see most people are in the buy section. There's a couple holds. And we can go through this. I think I did this in the first session. So if you missed the first session and this is the first time being part of EYLU, definitely go back and watch the first one because I show you how to use the analyst research, but also use it through AI. Tonight, I wanted to go a little further. So I said, let me hold off on the AI one. I'm going to show you how to get this done in real life. All right. So we're looking across the board. It says snapshot charts. Here goes the big word that we're looking for. Options right here. Here it is. Here it is. So we click it. It's going to take us to that screen that I took a screenshot of. Now, here's our symbol. It tells us the option chain. Remember, calls are on your left, right? Puts on your right. Here are expiration dates. They go across. And so I can do all months. Watch where it right now it has to May 10th, which is this Friday. That's next Friday, Friday after. Let's go out as far as we can. See how when I click this, it starts moving, the expiration dates. So I always do this. This is like a pet peeve of mine. I always check to see how far it goes out. I'll be the first person to text my people like, yo, they went out to December 2026, y'all. There's new calls. We got to look into it. They're like, yo, why you know that? I'm like, because I'm looking. I'm always watching. I want to see how far it can go out. I want to extend my contracts out as far as possible. So I'm always the first one to know when these new calls come in. So December 2026 is the furthest we can go out, which is 2.5 years from now. So for this purposes, we'll go. I can change this, right? I can do calls. I can do puts. We can do a bunch of other things. This is for my advanced people. We're going to keep this for beginner, intermediate. So for now, we'll put calls. They want me to zoom in a bit. Okay, I'll zoom in. Let me see. Let's zoom in. Tell me when I'm good, Magda. Like, what button was that? Let's zoom in a little bit more. Let's zoom in a little bit more. We good? How's that? I'll go a little bit more too. I'm getting a message. She said that's better. Let's go on one more. All right. So now we should be good now. All right. So she says yes. Perfect. Gotcha. All right. So I'm clicking here, right? Like I said, it's calls or puts. For this purposes, let's just look at the calls. We want to look at appreciation because, like I said, when we're talking about puts, we're not going to have them this far out, right? The likelihood of a put happening it's just the likelihood isn't great. It's not in our advantage. We want to put ourselves in the best position in the most probable circumstances. And so just look at calls only. Now, this is interesting. So it's only showing 7, but we know that Apple has a tendency to appreciate. Right now, it's consolidating. We're going to go over that chart in a sec. And so rather than looking at 7 strikes, and here goes our strikes. Remember, I told you it's right in the middle, the strike price. It is right here, right? Let me click this. Let me click December. So you see how those prices changed? Those prices are a little bit different. Those prices are a little bit different, right? Let me show you again. Let's go back to, let's say like June of this year. So that 185 call, right? If we move this over to move the decimal over twice, we got 495, right? Or at this point, $500 per contract, right? Or we got $275 per contract, or we have $70 per contract. That's not a bad one, actually. That's not a bad one. You know why that's not a bad one? I'm gonna tell you just a little. I'm gonna let you inside a little secret. It's not a bad one because $70 per contract means that I have affordability there, right? I could buy 4 contracts and feel comfortable. It's at a number that is not too far off from where Apple is now. It's like maybe an 8 to 9% increase. Plus, we know what is. Remember, I told you economic factors, right? We've been talking about it, right? Well, the iPhone sales have been down. We've seen some decrease in some of the profitability from the revenue of that. But we know that June 7th, something's coming, right? Whether it's the initiative in AI, something's coming. And so when I'm looking at this call, I'm thinking to myself, that might not be a bad place if I'm doing like a, little swing trade. Might not be a bad place. And plus, I'm looking at the value, There's a lot of volume here, and look at all this open interest. There's a lot of people. A lot of people probably thinking the same thing I'm thinking. In fact, most people are thinking that 200 number. But if we want to see all, this is like a little, that's like a little cheat sheet. That's how I would look at this, right? I know what's happening in June. That's June 7th. This is 3 weeks after that, or 2 weeks after that. I can get this now leading up to it. This might not be a bad trade for me. But let's go to look at all of them because we can go out further. We don't have to stay in 7. We can do all. And then it gets a little bit more complicated, right? So now we're talking about looking at prices from 185 all the way to 290. They don't even have prices for these yet. These are this is 2 cents. This is 2 cents. So I mean, the likelihood of Apple going to 260 in 6 weeks, very slim. Probably impossible, right? I'm going to say impossible. But the chances of it getting to 200, it could happen, right? 195, right? The way it's been trending. We'll go into the chart now to see what that looks like, but it's possible, right? 185, it's at 184 now. So the likelihood is higher. But if we go out further to the December calls, you're going to see, let me move this in a little bit more to like 11 so we can get the screen back. Oh, no, I'll make it 7. I'll make it 7. If we look at December, which is, like I said, 2 years out, now let's start looking at these prices. Now we go from $400 to nearly $4,000, right? So that's a drastic change. That's a drastic change in pricing because the likelihood of it happening or the probability of it happening greatly increases because you give it more time. But this is something I want you to do, especially if you're using E-Trade, especially if you're trading options. I always want you to hit this word right now. Most people never read details. It's like the fine print, but that's where all the information is, right? So like if I want to know something about this call, I got to hit the details. So I'm hitting the details. It takes me to this page. This is the page I want you to be making sure that you're focusing on, right? So this is the call. Here's that price. I told you here, this is where we got to look at, right? This underlying stock price. This is what Apple's been doing over the past 5 days. Here's what it looked like for the past month. Here's what it looks like for the past year to date. So it hit up here, 195. Let me move the screen down a little bit. In January, and it has been trading sideways pretty much since. We got some news after earnings that they bought back some shares, right? Largest share buyback in history. They also said that they're going to give out a dividend, and they kind of teased that something's coming in June. And so we saw on May 2nd, when they had their earnings call, we saw a quick spike. So it went from 170, shot up to 183. And it's kind of been sitting in there in that range for the past couple of days. I think they just announced a new iPad. I'm not sure what that's going to do for revenue. People are just waiting. They're waiting to see what's coming from Apple because something needs to happen very shortly. All right. So that's the underlying price of Apple, the stock. Here's the price. So this gets tricky, right? Here's the price of the option. So it probably didn't have a year to date. So we got to go short term. So we start looking at these things like these breaks, right? When you start to see a break like that means something happened here, right? Volatility, the option chain couldn't catch up. And so it stops here and then it picks up, right? So it's open probably at 33. You can see it's trending. This is not something that I'm interested in. I wouldn't be interested in this, right? Because I need to see depreciation. This is definitely something that's been trading sideways or is appreciated a little bit. I wouldn't be interested in this call. This is not something that I'm looking like, we're going to make money here, right? That would just be my per se on that. But again, when you do your own research and you have your own time, feel free. So again, we looked at the volume. This is way out, so the volume is going to be a little bit lower. The open interest is a little bit lower because nobody's thinking 2.5 years out. So the open interest is obviously going to be lower. We saw when it was closer, it was 81,000. The number was 81,000 on open interest for June. Obviously, nobody's thinking about December right now. They're figuring out we can make money short term. We'll worry about December when it gets here. I like to look at it just because I want to say, all right, is there opportunity? If this depreciates enough, can we find some value? And then if we scroll down, there it is, that number I told you, that DTE, right? Here's the share price. This will calculate your risk. So that's why I love E-Trade because it gives you all this. And then does it have the Greeks? It usually does have the Greeks. We got to go over the Greeks, but that'll probably be in our next. That's like a mid to advance. We're gonna go over the Greeks and tell you what that means, alphas and betas and all that, the gammas. but the DTE is 954 days, so we got plenty of time, right? It talks about the volatility, right? That's what is the probability of the movement, and then the interest made on it. So this is important. If we could calculate, it'll calculate a number for us. There goes the Greeks. Yeah. Don't worry about that just yet. We're gonna come back to that. We're gonna put a pin in that. I want y'all to remember that. That's very important. That's very important stuff. All right. So this is exactly what an option call looks like. And if I go back, I can do this on a bunch of companies. We could do this on Meta. Take a snapshot of it, right? And again, it'll give us this, right? We can look at the fundamentals of the company. I don't know if people like to do fundamental analysis. If I have time, I'll do it. So this is always important to see, right? The balance sheet is important. We went over that on the last call. Income statements is important. These are things that when most people don't look at. Also insider activity, right? And so insider activity, we always like to see ownership. This is important, very important, right? Because I want to see who owns the company, right? And most times when you'll see these huge mega caps, I mean, these are Magnificent Seven, you'll start to see investment managers, right? Who owns most of the company? Well, you can see. Let's scroll down. Here are our owners, right? Every time you'll see a tech company, you will see this name. You will see BlackRock inside of it, right? They have heavy investors, and so we're talking about huge sums, right? This is their position inside of Meta, 36 billion. It's a lot, right? These are the numbers that we look at. Institutional investor versus retail investor. That's something that people should really start to figure out what is what. And so 26% of ownership in Meta is retail, which means the everyday person, and then 70%, 75% of it, or 74% of it really is institutional investment. And so if there's institutional investment, you're talking about strong companies, because institutions want to back it. They want to be a part of it. They want to see gains in it. They want to see income from it. All right. So that's another quick piece of research that I think people should look at, especially if you're trying to evaluate a new company. I know a lot of people want to find new companies. That's great. Make sure you do all the research on them. All right. Oh man. So this is Yahoo Finance. Let me see if I can make this bigger so I know people can really figure out what we got going on here. Give me 2 seconds. I know it's Apple Plus. Why? Let me see. I know for some of our new folks, you're like, Troy, what is this thing? Well, when we talk about technical analysis, this is technical analysis, and this chart has been built out. So this is how I look at my screen. You can see I have my moving averages, right? I have my 50-day, which is represented by purple. I have my 100-day, and I have my 200. Then I have my Bollinger Bands. Those are just a deviation from the lows and the highs. Something that I always look at. I know Ian hates it when I talk about it, but I have to, man. I have to talk about RSI. This is the relative strength index. This tells you whether a stock is being oversold or overbought. Now, how will you know it's oversold? Well, you see this number 20? If it goes below this number 20, that means people are overselling the stock. There's no reason for it, right? We don't really, there's not really, there could have been some news or economic factor, but it's being oversold. When it's overbought, you can't see it in here because 66 is covering it, but it usually goes over 80. I like to make my numbers even more condensed, right? If I see it go over 70, I know it's starting to be overbought. I don't want to, it's not a good time for me. And so right now, over the past 14 days, Apple is at a 66. And so it's getting to that point where it's overbought, which makes sense because if I look at this bottom line, right, it says value. Remember I told you about value? Look at these trades. I told you a million would be okay for me. Look at what Apple's doing. 52, 65. Look what on May 2nd when its earnings came out. Look at this. What's that number? 163 million. And so you can see that gap, right? Where it closed at to where it opened at, right? We talked about it on that last chart. It went from 172, spiked up to 180, and now it's kind of sitting. But if I look it out further, Apple's kind of been, consolidating a little bit. It's had this sideways movement. It doesn't look like it did from January of 2023 to July of 2023, when you just saw a steady climb in Apple, right? Right now, it's pulled back here in August of 2023, and it's kind of just been finding its way, right? AI has been taking over. They haven't really made their mark in it yet or made their announcement, which is why I kind of like Apple, right? We love it. We already know what it the brand represents, but as a stock, right, from a technical standpoint, I'm looking at this consolidation. I'm thinking to myself, there might be a buy-in point here, right? Because it hasn't performed like Nvidia has. It hasn't performed like Microsoft has. It hasn't even performed. Let me see if I can put Amazon up. We could just compare it. Let's see if Amazon. Yeah, look at Amazon. So Amazon's represented by that green line, right? Look at Amazon's performance and look at Apple's performance, right? It hasn't performed like it's magnificent. If we put Nvidia up there, forget about it. Let me see. Whew. Right. So these are its contemporaries, right? These are the other magnificent 7 companies. And compared to them, it hasn't moved the same way, right? And obviously, we talked about it on Market Mondays about this slowdown in the sales, but innovation is key. And I believe in Tim Cook. He has a great track record. So I believe that Apple has, I just think this June announcement is going to be huge for the company. And so if I'm looking to invest, I have a number I'll show you at the end of where I'm looking to get in at. Because I think there's something here with Apple just because of this consolidation in the chart. But I know most of you are like, wait, I don't even know how to read a chart. That's fine, right? I always tell you there's going to be resources. Even if you don't know how to read a chart, you can go to this website, Bar Chart, and it'll give you all the information. Very simple, right? And so Bar Chart is a great site, and I'm going to give everybody all the sites that I'm using. At the end, I mean, there's like 16 of them. I could go through all of them tonight, but I'm going to give you all of them so you can like comb through them and see them for yourself. And so, I mean, look at the key points. It tells you right here. Here are the 52-week key points. Here's the high. If you do Fibonacci levels, we didn't even put Fibonacci up there, but here are the Fibonacci levels. But if you go to price overview, well, let me scroll down here so you can see this. So you can see the price performance. Here's what it's done for the past 5 days. Here's what it's done for the past month, 3 months, 6 months, year to date. Here's the 52-week. Here's 20-year. Look at this percentage. It's up 36,000% over the past 20 years. Wow. 36,000%. Who would have known? Okay. All right. So the past 10 years, I mean, past 10 years, not a slouch yet. We're talking about 708%, which is really incredible. For those of you who are looking at the charts, though, it's like, well, how do I know? I keep hearing people telling me support, resistance, right? If I look at this chart, close this. If I look at this chart, well, how do I know support and resistance, right? There's a line here, right? So if I'm following trends, right, I'm looking at the bottoms, right? That starts to become the support, right? And so we start to see lines here. You start to see mountains, right? Hills and valleys. You start to see peaks, ebbs and flows, right? You start to see green. When your eye starts to get trained for it, you start to notice the support levels, right? But if you're a beginner, this is very easy. You go to bar chart, type in Apple, APL. It's already here, but I'm going to show you anyway, right? I'm going to go to price overview. It's already locked in on it. It tells me everything I need. It gives me the charts. But at the bottom, if I scroll all the way down, it's going to tell me the key turning points. So when people tell you about the support level, you can tell them, I know what it is. You're not any better than me. My eyes are getting trained. I'm getting better vision. But right now, I got a little support with my vision. And so here goes your first support level, 182, right? Here goes the second support level, 181. There goes the third support level, right? Support means where it's falling to. It's hitting this line, it's hitting support, and it might be bouncing up, or it might run through support and go down. If it hits that third support level and falls down, it could be falling further. On the opposite, or the inverse, we have resistance. So it hits a number and it goes down, right? So it goes up to 185. Can it make it past 185? If it goes to 186.33, can it go past it? Now, if it goes past 188, then we're talking about a run. Now, if you want to click to see more, you could. And then it will give you even more information, right? And so I don't have to have the trained eye to read a chart, right? I don't need my Fibonacci and support and resistance and Bollinger Bands and MACDs and RSIs. I could use this until I'm comfortable enough to look at a chart and say, I know what I'm looking at. Okay, I got it. Now, here's a site that I'm using. And I put it in slideshow as well. And I don't think I've told anybody this, but this is a cool site. It's called investorbusinessdaily.com. Why do I like it? Especially for somebody who's beginning. It's because it has this right here, right? So obviously it has plenty of information about the market. You can go through trends, you can go through ideas, stocks, EV. I like to go to the leaderboard. So when I click their leaderboard, check this out. This is pretty dope. So they have a leaderboard of companies that are performing. So Lilly is one of my favorites. Let's click Lilly. Now it'll start giving you, I'm going to zoom in a little bit because I know people are going to be like, Troy, can you zoom in? I'm going to zoom in. I got you. I'm with you. It starts giving me information on the chart, and it also gives me market and industry performance, fundamental performance, and technical performance. So if I didn't know, I could just go to technical performance and see, right? Well, how far am I off the 52-week high? We're 4%. Okay, that's easy. I can read that, right? 50-day moving average value. So how much is it trading over the past 50 days? Oh, it's doing about 2.8 million trades. Oh, okay. I can read that. This feels like something that's doable. That's what we're trying to do. We're trying to make this very, very doable for everybody. And so, like, this is one of those sites. I think it's a great one. It's like almost a cheat sheet because it starts telling you the information. You don't even have to. All you need to do is read it. So it can do it for you daily. It could do it for you weekly. It could do it for you monthly. And it could do it intraday. Shout out to all my snipers, right? All my scalpers. And shout out to my snipers too. The Red Panda family in here. I know they're in here. Shout out to them. All right. And so this is a great site. I like to use it as a tool. I think it's great. You can use it as a tool. Again, I'm going to give you all these sites that I'm using. Everything that you've seen here today, you will have. That is a fact. That's a guarantee. All right. Let me go. Where am I going to next? Oh, they're going to say, Troy, you didn't show them the portfolio. All right. I got you. I'm coming with it. Let's add me back to the stage. Get me back in here. All right. So we looked at the Apple trend line. I showed you some consolidation. Economic factors, economic factor, especially when we're talking to a company like Apple, is that June 7th, right? What's going to happen? Interest rates, CPI, PPI, those things happen every month, right? When we're talking about jobless claims, all those things play a part into it. Finding the undervalued contracts, that's when we're looking inside the actual option price to see if it declined or appreciated. Maybe I should show that. Mag, should I show that? I'm gonna show that. I'm gonna show a depreciated one. I showed how Apple didn't depreciate. I think I'm gonna show one that actually did depreciate. Let me go back. I'm gonna give you everything. Let's go to E-Trade. Let's see if I have to log back in. You can see me? I can't hear you, but if you give me a thumbs up, that'd be great. Let's go back to Hub. We're going to HubSpot again. This is just like one of the ones I like to do. And I'll use the 650. What did I use? I think I used the 650. Let's see the 650. It should be down even further. Let's go out a little more. I'm going to zoom in a little in 1 second, y'all. Give me 2 seconds. I don't think it'll let me go any further. All right, so I'm going to go to the 650. Let's see those details. Oh, Greg said I got a thumbs up. Oh, this is perfect. So now when we looked at Apple, because the stock went up today, we saw all the calls go up. But now look at Hub, which went down $2 today, less than like 0.5%. Look at all the calls. Look at all these calls. Down $22. Down. All these calls have gone negative, right? Now this is for next Friday. But all these calls have shown me depreciation, right? If there's a company that I'm like, oh, wait, why did it depreciate? Was there something fundamentally that went wrong? Well, if you look at their report, they beat on earnings again for the 9th quarter in a row. They talked about positive revenue, but they had mixed guidance. So mixed guidance it's tricky, right? I watched Josh Brown. I wish I had the clip. I put it in here, but maybe I'll put it in the chat. He's actually talking about how Uber has finally made profit, finally turned, and people are talking about its mixed guidance. It doesn't even make sense why it's trading low. But sometimes that's just how the market moves. It loses confidence. And so that open interest is still high here at the 650. I'm on this line right here, the 650. Here's the open interest. Here's the volume. Let's go to the details. We got to go inside there, see what's going on. All right. This is the underlying price of the asset. So was that 615? I told you I was there, right? Got up to 617. Boom, dropped down. Well, look where it opened. Back at 610. It got up to intraday. So this doesn't have intraday. Intraday, it got up to 620 this morning. We let go of it, and then it went back down. Let's see what the option looks like. More depreciation, right? Like this would be something that I would look at and say, all right, let me check the volume on it. Let me see what the news is on it. But like, look where it started at 23. Man, we're down almost 80%, right? Like this might be an opportunity if I'm scalping or if I'm day trading and I'm trying to make a quick dollar. That's why I showed y'all, because everything is not a long-term investment. Some people are like, I just want to make money today. What's the best way to do it? I would be looking at depreciating assets like this or depreciating calls like this to see, all right, if I get it at this low point, will it get back up to, I don't know. And we've seen it. If we watch, let's go to Hub's chart. Let's go to Hub's chart. G, you can see this chart? You can see it? Just give me a thumbs up, bro. Right? We went over this. Yes, perfect. Y'all good. All right. I'm good. We watched their chart the other night. Oh, did I zoom out? Let me zoom in. Right? Let me close this for y'all. Get these plots out of here. Okay. Right? We've watched this trend line. Every time it bounces off the 50, here it is at the 50. Here it is at the 50. Here's at the 50. At the 50 again. Came back up. Didn't meet it. So this is when we're talking about support and resistance. Right? Now, this would be a time where it's like, all right, where do I find that support and resistance at? Can it get back up? We'll see. We're already up after hours $1, almost $2. And so it likes to, if we watch Hub from a distance, if we like look at the chart, like it goes through these ebbs and flows of bouncing, right? But notice the trajectory of the stock, right? Pandemic, it fell down. And since the pandemic, right, the collapse 2022, right?
Troy, they're not seeing your chart.
Oh,
It
damn
froze.
it. Okay. Let me go back. Let me go back. I thought I was cooking. Oh no, it stayed on the. I got you. It stayed on the other screen. Let me remove it, and then I'm gonna come back to it right now. I'm gonna share. I'm sharing this screen. You got me now, right? You can see it now? I think so. Yes. Okay, perfect. Yeah, we can see post-pandemic, obviously it pulled back here. It had its high at 833. And this is a lot to do with the space in the industry, and obviously AI has something to do with it. Salesforce has something to do with it as well. Obviously, being a leader in the space, we're seeing a slow climb. We're starting to see that climb. We got in space in October when we at Market Mondays live in Chicago. Shout out to everybody that was there, and we've seen appreciation since. And so this is something we got to be patient with. I'll be interested to see what this is at mid-month. So I'm keeping my eye on that one. Definitely keep my eye on that, and I think you should too. I think you should as well. All right, now let me go to. They're gonna say, Troy, you didn't do it, so I am gonna do it. I'm gonna do it. What's in the portfolio? Let's do it. All right, I'm gonna go off the screen so I can see what's in the portfolio. Take a look. This is what's in my portfolio, y'all. This is my portfolio. This is one of my stock options portfolios. We've had to, consolidate a few things. We're taking some losses, but I want you to notice one thing. There's one thing I want you to know. Well, a couple of things. Number one, yes, some of these percentages are great, but look at the time frame on some of them. So you can notice that I don't have many 2024s in the portfolio. I have a bunch of 26s because, again, I want to go out as far as possible. So you could imagine what this NVIDIA 800 call will look like by January 26th. And you could only imagine what this NVIDIA 455 call will look like by the time we get to December 2024, interest rates get lower. And even this TSM, I'm excited to see where that goes. And obviously the June 205 call is still there, hovering at almost 1,300%. So we're proud of that. And we yo, I told him, listen, this is Family Matters, all right? Not like Drake's Family Matters, like EYLU Family Matters. Like what you see here is for motivational purposes only. But we can't discount the losses that are trailing right now. So I know Tesla is down there. My Apple 190 is down there. My ASML is down there. I still believe in those. In fact, I might buy into those options to dollars cost average in those. The Tesla one I really love, even though they're having some issues right now. I can't even see the other one. What is that one? I can't see it. My face is in the way. Let me exit full screen. All right, there we go. That's my Disney stock. Shout out to Live Nation. That one, another great one. Y'all see, I still love my DraftKings, y'all. I ain't let up on that just yet. And what else we got? Oh, this is key. So the stock ownership inside of here. And so the equities that you see that don't have the word call next to it, those I own shares in. And so if you look at the third line here where it says NVIDIA, those are shares. Those are not calls. Those stay with me for long term. However long I want to keep them, I keep them. Same thing with Meta, Amazon, Microsoft, Apple, and Disney down there, just holding up for dear life. Shout out to Disney. That's one of those ones that, you know what, I might have gotten that one a little too early. So yeah, you do make mistakes, but you learn from them. Here's what I want you to see though, right? Obviously I want you to see that because it's possible. You're talking about a guy 6 years ago that was teaching kindergarten students, 5th grade students, 1st grade, 2nd, 3rd grade students, that has now taught himself and made himself a disciplined investor. And these are the results if you do that. And so that's why I showed it, because it can be encouraging. I want everybody to feel that it's possible, because it definitely is. These returns are very possible. It could be life-changing money, or it could just be, money that I need. And so both things are probable and highly likely, but you got to be disciplined. You got to figure out who you are, and you got to create a plan. So if you haven't watched the first 2 classes, I highly suggest you watch the first 2 classes, because the first one we break down some of these topics. We went a little bit more in depth today. And then the second one, we talk about how to break down and figure out how to create a table for your investment strategy. So that was stock ownership, stock contracts. So I want you to see the contrast. But this is dope too. I think stacking is dope. I don't know if I've seen anybody do this yet, but this is important. And so I always tell you that I'm creating my table. And so, NVIDIA is on my table, but NVIDIA has had such a great run. Not only did I get it at the 205, as I saw it appreciate even higher, I went and got the 455. I saw it appreciate even higher. I went and got the 800 call. I saw it appreciate even higher. I said, all right, well, if everybody's analysts, I think 94% of analysts has a price target at 1,000. Who am I to fight the analysts, right? This is what they do for a living. And so now I get the 1,000 call. Now I have I could exercise all these calls, or I could just take the percentage for the money that I put in and take the appreciation and say, all right, it was great, NVIDIA. I love you. I got you long-term. I'll see you at 1,200. Or I could say, you know what? I'll exercise the 205, get 100 to 300 shares there, and have appreciation or a value of over maybe 120,000. Did the math right? If it's about 60,000 equity, like almost 180,000 if we do the math right. But who am I? I'm not great at math. And then the 455. I mean, that becomes even more enticing. Let's say NVIDIA does get to 1,000. Well, I have at least 5 contracts here where I can get it at 455, and you're talking about another $600 in equity for each share. So, stacking it is a way that you can definitely make a lot of money. And it's something it's very doable. It's very doable. If you can watch the trends of the market, if you can see how the trajectory, some of the innovation, and who's leading in that innovation, it definitely becomes something that you should take advantage of. So I'm definitely showing you that it is possible. You can stack the stack play. Write that down, Magda. The stack play. The stack play. All right, so I couldn't leave you out without telling you what I'm looking at next. I wasn't going to do it to you. I wasn't going to do it to you. And actually, I put some of the ranges that I'm looking for these targets. And so these are the companies that I'm looking for next. I told you I don't, and Ian asks me all the time, but I'm like, yo, bro, I really only do about maybe 15 to 20 trades a year. And so I have to be very calculated with it. As you can see, all those ones I've done, those are for 2026. I probably did at some point earlier this year or last year. The ones that are 2024, you don't even see anymore because I don't have any. And 2025, there are a couple because 2023 was a down year. So it was like, all right, either I can get in and get out. Couldn't figure it out. So I said, let me just sit tight for a second. Then when everything settles and we start seeing a bottom, I'll start investing again. And so Visa is definitely one of my next targets. I just think it's a solid company. If you look at this track record, if you look at this chart, the way it's trending, I mean, it's too good. I missed it at 205. I actually had it in the pandemic at 205, and I made a very bad decision to let it go. But obviously, you can see it's doing well right now. Apple, I just showed you why I'm looking at it. I think I'm going to make a move on that very soon. So I didn't even put a price. Soon as the price. Soon as my price. Like that. That's how much I'm looking into Apple, even with all of the news that we saw with the iPhone sales and we talk about innovation. It's one of these things where it's almost too big to fail at a certain point. But if it does fail, I'll be willing to say, all right, I'm comfortable with being in that position. And if it does go right, which I believe it will, just because of the leadership and the brand loyalty. It's just a firm belief in it. Netflix, man, we watched this thing, and shout out to Bam. I know if he's watching, we had a whole conversation about this about a year and a half ago, and he made his own decision, and I made mine, and we'll just leave it at that. And it's definitely one of my next targets. I'm looking to get it in this range. I know it's trading well above that right now. I think it's at the 613, and that's okay. That's okay. That's part of being disciplined. You don't want to chase it too high. And if it does keep running, then obviously I'll have to readjust. So I'll have to say, you know what, maybe I have to find a new target. And then one of my sleepers, I think, which is incredible, and most people never talk about, is Thermo Fisher. During the pandemic, I was just like waving the flag, Thermo Fisher, when people didn't know what it was in the healthcare field, as far as when it came to the vaccine and bottling and manufacturing, the role that they play. But it's just such a strong company with great fundamentals. And if you look at the technicals, it's really, really good. So definitely Thermo Fisher is one. And I didn't put Amazon. I should have, but Amazon for sure. You saw that I own shares in Amazon, full disclaimer. So I'll be looking to get maybe a call in the near future on Amazon as well. So those are my 5. Those are the 5 ones I'm looking at. I'd be super interested. I think that's what I want to do. I want to see some of the ones that our community is looking at. I want to see them. Let's put them in the chat. Let's put it in the community. Let's build on them. Let's do research on them together. Because I think that's how we grow, right? It's good that, these percentages are great and it's great for me. But what's more beneficial is that if people are actually making money from some of the information and they're sharing it. I think that's what Market Mondays has been built on. I think that's what we've been built on. So we're going to continue to do that. So we appreciate y'all coming to the session. We appreciate y'all being here. Hopefully, everybody was eating their dinner and taking notes. I did not eat dinner. I barely drink any water. I'm filled right now because I'm like, yes, we got another session off. We'll be back obviously next month, but I know we got Magda. I'm gonna call you up for 2 seconds. Hold on, let me get on the screen. Let me get you on the screen. I know we got our boot camp leaders that are now been going to be heading this space with me, and so I'm excited to have them on board. I had a surprise call with them the other day. We got some really, really good people that are going to be with us. We got some dope things happening at EYLU. Magda, I got to fill you in on some things on the call tomorrow. So I'm excited for it, man. I appreciate all y'all. I can't see y'all in the chat, but Magda says that y'all are saying great things. And so y'all know love is love. I'll see y'all on Monday for Market Mondays. And obviously we got some big announcements coming from the Earn Your Leisure InvestFest fam next week. So stay tuned, y'all. Love is love. Be good to each other. Share the information. I want to see what companies y'all looking at. I want to break down some fundamentals, some technicals with y'all. Let's do it. Love is love. We'll see y'all next time. Peace.